The COVID-19 pandemic reshaped our world. It also reshaped commercial real estate. Before 2020, offices bustled, stores were full of shoppers, hotels welcomed travelers. The pandemic changed all of that. Lockdowns and restrictions forced businesses to close. People stayed home. This had a huge impact on commercial real estate. The once thriving sector faced an uncertain future. The pandemic accelerated existing trends. Remote work became the norm. Online shopping grew exponentially. These changes had a profound effect on commercial real estate. The demand for office space, retail stores, and hotels plummeted. The initial lockdowns were a shock to the system. Businesses shuttered their doors, tenants struggled to pay rent, property owners faced a wave of defaults. The commercial real estate market froze. As the pandemic dragged on, the problems worsened. Businesses closed permanently, vacancies rose, property values declined. The commercial real estate sector was in crisis. The impact was felt across all sectors. Office buildings emptied out. Retail stores struggled to compete with online giants. Hotels sat empty without tourists and business travelers. The future looked bleak. The rise of remote work is a defining trend of our time. The pandemic accelerated this trend, forcing companies to adopt remote work policies. Many employees found they enjoyed the flexibility and work-life balance. This shift has major implications for office spaces. Why do companies need large offices if employees work from home? The demand for traditional office space has fallen. Some companies are downsizing their office footprint. Others are adopting hybrid models. The future of office space is uncertain, but one thing is clear: the traditional office is changing. The retail and hospitality sectors were hit hard by the pandemic. Lockdowns forced stores and restaurants to close. Travel restrictions decimated the tourism industry. This led to a wave of bankruptcies and closures. Even as restrictions eased, these sectors faced an uphill battle. Consumers turned to online shopping. Many were hesitant to return to crowded stores or travel. Vacancies in retail and hospitality reached record highs. The future of these sectors is uncertain. The rise of e-commerce is a long-term trend. The pandemic simply accelerated it. Retail and hospitality businesses need to adapt to survive in this new environment. The problems in commercial real estate have serious implications for the banking sector. Banks hold trillions of dollars in commercial real estate loans. As property values decline and defaults rise, banks face significant losses. Delinquency rates on commercial mortgages are already increasing. This is a worrying sign. If delinquencies continue to rise, it could trigger a banking crisis. The government and financial regulators are closely monitoring the situation. They are aware of the risks and are taking steps to mitigate them. But the possibility of a banking crisis remains a real concern. Expert opinions: assessing the depth of the crisis. In this section, we delve into the insights provided by leading economists and financial experts who are closely monitoring the unfolding crisis in commercial real estate. Their perspectives offer a comprehensive understanding of the potential ramifications and the depth of the challenges ahead. Experts are sounding the alarm about the crisis in commercial real estate. The sector, once a pillar of economic stability, is now facing unprecedented challenges. The combination of high vacancy rates, declining property values, and increasing debt levels has created a perfect storm that threatens to destabilize the market. They warn that the worst is yet to come. The current indicators suggest that the market has not yet hit rock bottom, and the situation could deteriorate further. Financial experts are particularly concerned about the potential for a cascading effect, where the failure of one segment of the market could lead to broader economic repercussions. Some predict a wave of foreclosures and fire sales. As property owners struggle to meet their financial obligations, we could see a significant increase in distressed sales. This would not only impact property values but also have a ripple effect on the broader financial system, potentially leading to tighter credit conditions and reduced investment. Others believe the crisis could trigger a broader economic downturn. The interconnected nature of the financial system means that problems in the commercial real estate sector could spill over into other areas of the economy. This could lead to a slowdown in economic growth, higher unemployment rates, and increased financial instability. Pat Jackson of Sable Capital Partners warns of a two-headed monster. He describes the current crisis as having two main components: the immediate financial stress on property owners and the longer-term structural changes in the market. These changes include shifts in demand for commercial space, driven by factors such as remote work and e-commerce. He points to the divergence in the market. While some assets, particularly those in prime locations or with strong tenant bases, are performing relatively well, others are in deep distress. This divergence creates a complex landscape for investors and policymakers to navigate. Some assets are performing well while others are in deep distress. This uneven performance highlights the importance of careful analysis and strategic decision-making in the current environment. Investors need to be particularly vigilant in assessing the risks and opportunities presented by different segments of the market. Adam Slater of Oxford Economics highlights the risk of financial system stress. He emphasizes that the challenges in the commercial real estate sector could lead to broader financial instability. The interconnectedness of financial institutions means that stress in one area can quickly spread, potentially leading to a wider financial crisis. He warns that the deteriorating real estate market could have ripple effects throughout the economy. The potential for widespread financial distress underscores the need for proactive measures to address the underlying issues and mitigate the impact on the broader economy. Policymakers and industry leaders must work together to develop strategies that can help stabilize the market and support economic recovery. Mitigating the impact strategies for a brighter future. Despite the challenges, there are reasons for hope. Communities and organizations are coming together like never before, showing resilience and innovation in the face of adversity. Governments and businesses are exploring strategies to mitigate the impact of the crisis. These efforts are multifaceted, involving policy changes, economic interventions, and collaborative initiatives. These strategies aim to stabilize the market and prevent a wider economic downturn. By implementing measures such as financial stimulus packages and regulatory adjustments, the goal is to create a more resilient economic environment. One proposed solution is to convert vacant office buildings into residential spaces. This innovative approach not only addresses the surplus of unused commercial real estate but also tackles the pressing issue of housing shortages in urban areas. This would address the housing shortage in many cities while also finding a new use for empty offices. By repurposing these spaces, cities can provide affordable housing options and revitalize underutilized areas. Another strategy is to provide financial assistance to struggling businesses. Small and medium-sized enterprises are the backbone of the economy, and supporting them is crucial for economic recovery. This could take the form of loans, grants, or tax breaks. By offering these financial lifelines, governments can help businesses stay afloat, retain employees, and continue contributing to the economy. The goal is to help businesses survive the crisis and avoid further job losses. By implementing these strategies, we can work towards a brighter future, ensuring that our communities and economies emerge stronger and more resilient. A new era navigating the future of commercial real estate and banking. The COVID-19 pandemic has fundamentally changed the commercial real estate landscape. What was once a thriving sector filled with bustling office spaces and crowded retail stores has now seen a dramatic shift. Many commercial properties are left vacant, and the demand for traditional office spaces has plummeted. The old ways of doing business are gone. Companies are rethinking their real estate strategies, leading to a significant transformation in the market. The once standard long-term leases are being replaced by more flexible arrangements, and the focus is shifting towards creating adaptable and multifunctional spaces. The future belongs to those who can adapt to the new reality. Businesses that embrace technology and innovative workspace designs are more likely to thrive. Collaborative office spaces and remote work setups are becoming the norm, and companies are investing in creating environments that foster creativity and productivity. The rise of remote work, e-commerce, and other trends will continue to shape the sector. The demand for traditional office spaces may never return to pre-pandemic levels, but new opportunities are emerging. E-commerce has led to a surge in demand for warehouses and distribution centers, and the logistics sector is booming. Commercial real estate developers and investors need to be innovative and forward-thinking to succeed in this new environment. They must focus on creating spaces that meet the evolving needs of businesses and consumers. This includes incorporating sustainable practices, leveraging technology, and designing flexible spaces that can adapt to changing demands. Banks need to be cautious in their lending practices. The uncertainty in the commercial real estate market means that traditional risk assessment models may no longer be sufficient. Financial institutions must develop new strategies to evaluate the viability of commercial real estate projects and ensure that they are making sound investments. They need to carefully assess the risks associated with commercial real estate loans. This includes considering the long-term viability of the projects, the financial health of the borrowers, and the potential impact of economic fluctuations. By taking a more comprehensive approach to risk assessment, banks can protect themselves from potential losses. The government also has a role to play in regulating the sector and preventing future crises. Policymakers must work to create a stable and transparent regulatory environment that encourages investment while protecting the interests of all stakeholders. This includes implementing measures to prevent speculative bubbles, ensuring fair lending practices, and promoting sustainable development. The crisis in commercial real estate is a serious challenge facing the United States, but it is not insurmountable. By taking decisive action, we can mitigate the impact of the crisis and build a more resilient economy. This requires a collaborative effort from government, businesses, and individuals. We need to embrace innovation, adapt to changing circumstances, and work together to create a brighter future for all.